Welcome to today's deep dive. So imagine a rebellious, super volatile tech startup suddenly deciding to act like a slow-moving utility company from the 1950s that just pays out steady dividends.
Right. It sounds totally contradictory.
Exactly. But that is, exactly what Bitcoin is morphing into right now. Our mission today is analyzing how recent July 2026 data proves it has completely morphed from this independent asset into a really complex global macroeconomic index.
Yeah, and you can see that structural change right in the recent price action.
Oh, for sure. We saw that brief rally up to, 63,945, and that was fueled almost entirely by short liquidations.
Yeah, traders betting against the price getting squeezed.
Right, but then that spike faded almost instantly back to 61,775. Okay, so let's unpack this.
Well, that fade isn't just your standard weekend market volatility. What we are seeing reflects this heavy institutional supply pressure that is fundamentally rewriting how these market cycles operate.
So the old model of, protocol having schedules driving the price is just over.
I mean, effectively, yes. Capital flows dictate this market now, not the halving schedules.
And, that supply pressure is coming from some pretty unprecedented corporate moves. Take Strategy Inc., for example. They just sold 3,588 Bitcoin.
Which is a massive shift in their treasury strategy.
Totally. And they didn't sell to trade. They sold to fund preferred stock dividends, which is wild because they were even projecting an $8.32 billion impairment loss for the quarter.
Yeah, that goes exactly back to that utility company analogy you mentioned earlier, using digital reserves to just pay out traditional yields.
Right.
What's fascinating here is how that exact corporate behavior validates a major shift in Wall Street's valuation models.
You mean the Salomon Brothers framework?
Right. They just introduced a new framework that actually prices Bitcoin directly against the global M2 fiat money supply.
M2 basically meaning, the total amount of cash and easily accessible money sloshing around the global economy.
Exactly. So they are no longer treating it as this speculative tech proxy. They are treating it as a direct macroeconomic hedge against currency debasement.
Wow.
Yeah, and when you look at those corporate liquidations alongside the $8.2 billion that drained from U.S. spot ETFs over 8 weeks, it just proves that institutional capital flows are firmly in the driver's seat.
Right. So if U.S. retail investors are exiting those ETFs, it makes you wonder who is actually stepping in to absorb all that supply.
Someone definitely is.
Yeah, and here's where it gets really interesting. Abu Dhabi's sovereign wealth fund, Mubadala, just drastically boosted its stake in the IBIT ETF by 16%.
That is massive.
I know, that puts them at over $566 million.
Yeah.
You have one of the world's wealthiest state funds accumulating heavily.
Right. You have this highly regulated sovereign accumulation happening through totally compliance-friendly wrapped securities in the U.S.
Yeah.
But contrast that with the forensic data we're seeing on the other side. Heavily sanctioned nations, like Russia and Iran, processed roughly $100 billion in crypto volume in 2025.
Wow, $100 billion.
Yeah, they are using the raw network to bypass the SWIFT banking system entirely, moving value completely outside the traditional financial messaging layer.
Wait, I have to push back there. So you're saying sanctioned nations are moving billions to bypass Western banking, while at the exact same time, highly regulated state funds in Abu Dhabi are buying up Wall Street ETFs.
I know, it sounds like a paradox.
How can a single asset serve two completely opposed global masters like that without the U.S. just bringing down the regulatory hammer?
Well, it really comes down to domestic gridlock.
Right.
The U.S. honestly cannot effectively regulate this global usage right now because domestic policy is just completely frozen.
Right. The SEC's broad deregulation initiative, Project Crypto, is totally stalled out.
Right, because lawmakers are actively fighting over the conflict of interest stemming from President Trump generating $1.4 billion from his personal crypto project.
Oh, right. The licensing deals and all that.
Precisely. The political debate over those ethical disclosure provisions is acting as a massive structural bottleneck. So while Washington argues over those domestic conflicts, the rest of the globe is just actively integrating the asset into their sovereign financial architecture.
And it's not just geopolitics, right? The underlying software protocol itself is being forced to adapt to entirely new technological regulations.
Yeah, the technological shift is just as big.
Like the EU AI Act going into effect. They're mandating machine-readable watermarks for generative AI content now.
Right, which requires a totally immutable ledger.
Exactly. So developers just launched this new Bitcoin-anchored receipt standard. Are they essentially turning the blockchain into a Like a glorified notary public for artificial intelligence?
If we connect this to the bigger picture, yes, they absolutely are. They are computing cryptographic hashes of AI content and anchoring them directly into a specific piece of the code.
The op return field, right?
Spot on. Think of a GOP return like a tiny permanent memo line on a digital check. It provides perfect, immutable timestamping.
So you can prove a specific AI video or data set existed at an exact moment in time.
Exactly, and you do it without bloating the network with massive files. And, while it secures AI, the blockchain infrastructure itself is hardening against future threats.
Oh, you mean the quantum computing threats?
Yeah, networks like CoreChain are now executing fully post-quantum transactions on a live mainnet, so it proves the underlying cryptography can adapt to future computational threats.
So what does this all mean? I mean, for you listening, if you are trying to track this market today, looking at tech adoption just isn't enough anymore.
Not at all.
You literally have to watch corporate dividend payouts, Middle Eastern wealth funds, and European artificial intelligence legislation. It's a whole new ballgame.
It really is, and this raises an important question. If a decentralized network becomes the foundational compliance ledger for European AI laws and sovereign wealth funds, does it inevitably sacrifice the censorship-resistant, rebellious nature it was originally built upon?
That is the big question. The volatile tech startup finally grew up to become the utility company. It's reliable, it's regulated, but it's entirely unrecognizable from its original pitch deck.